question that was kind of relevant to what you guys put in. It was with regards to from the previous accountant. Let me.
You mean a response from the takeover letter?
So say, okay, so they said, what if the previous accountant does not reply? What is the reasonable time to receive?
They don't. They should reply, but you know, like you said, if they do not reply, you know, like as far as that. You want to talk about the takeover letter?
I'm not sure, but
Well, the takeover letter will be coming up as an issue, so we'll readdress it.
okay, so like,
And the next question,
it's
what if they don't reply? What should I do?
it says what if basic and another person just commented. I think the reasonable time is stipulated is 15 days.
Well, yeah, I guess if you want to put a time limit on it, right?
So what would you, should I just let them know you're going to address it?
Yeah, yeah.
Perfect. Thank you.
See here?
Follow up, and you can bring it up later.
Okay, we'll carry on.
Okay, we're back.
We're back. We're back. We're back. Okay, so this one little earlier comment about my little friend over here. I just want to, also clarify that the fact is, where I hopefully I answer your question about the segregation of duty. If you are doing the bookkeeping services and you are going to be doing the review engagement, you're in conflict. So, like I said, ideally you have to do something that's segregated. So if you're going to segregate, you segregate the bookkeeping function, but that's got to be supervised by somebody else other than yourself. Then you achieve the segregation of duty. In theory, hopefully, or I won't assume there, but assuming that you're not an LPA there, you can't do the review anyhow, so you will achieve its segregation by having it signed by somebody else, because that other person will sign it. But there's definitely, you have to cut off the bookkeeping function and done it. So if you're doing it in a partnership, you should have one person in charge of the bookkeeping scenario of a particular client, and the other person does the year-end work. So there definitely has to be a segregation of duty. So I just wanted to make sure that that was clear, that's all.
1 second. Bring the mic.
Sorry. So even in the firm, let's say there are two LPA, one can be head of bookkeeping, one can be head of reviewing. That is segregation, right?
Yep.
Yeah,
Even
that's
though the
fine.
firm is
As
same.
long as there's a segregation. So in other words, the person creating the data is not that's what we call a self-review threat. So if you're creating your own data, like I don't know, I haven't mentioned it today, but think about it this way. You type a letter that's 500 words. You read it over 2 times, you think it's perfect. You give it to somebody else and they find 5 errors. You look at it again and say, how could I possibly miss those errors? Because in your own mind, you've missed that word or missed that phrase or missed that concept or whatever, because you said you've actually told them what the next word is, but the word's not there. So when another person reading it doesn't even know what you're saying, they're saying, aren't you missing a word here or something like that? So the self-review is a true statement, it's a fact. The other little comment, which I'll mention right now since it had to do with the same subject matter, if you are doing your own file, like whatever it is, give yourself enough time frame, especially if you do not have somebody else doing it, like from a compilation standpoint. In other words, finish the file on Wednesday, pick it up again on the Friday or whatever the case may be. So when you look at it, you're actually looking at it with a fresh eye to try to catch your own potential errors. You try to do a file from start to finish and try to get it out the door because it's due by the end of today. Your chances of errors are going to be that much greater. Okay,
Okay,
yeah.
I've actually got a couple of points to make on that. Let's fast forward a bit. Having just one LPA, you're not going to be able to operate that effectively or efficiently anymore. With all the rule changes that are coming place, you need the file to be reviewed. You need a second partner review or that kind of a situation. So you've got to have an environment. It's pretty difficult today to be a sole practitioner, and if you're a sole practitioner with audits and reviews and compilation, you're going to have staff. So to just have you as an LPA with one audit, you're probably not even going to have enough of a required to meet the CGA Ontario requirement to hold a license. So, right? So let's move forward, and those are the things that are that we're faced with now. We're faced with 3 people in our office that will actually look at one file before it actually goes out. And never mind that we have staff producing the bookkeeping. So it's pretty hard today to operate in that type of, me, myself, and I, just by myself.
But more so doing a review, or trying to do a review and audit. To get the qualified hours, and then also the fact that you're going to need, to keep it very simple in the terminology, a second partner review. It's part of the quality control, even more so in an audit.
Any other questions?
Okay, so we'll continue on.
Okay.
Okay, so takeover steps to follow. So remember, just because the person walked in the door, you can refuse them, and you should refuse them. So determine the acceptance of the engagement is appropriate. Okay, so in other words, also, do you like the client? But is the engagement that they want you to do, A, can you do it? And B, is it appropriate? Think about everybody. Everybody always wants a Cadillac. If you gave them a choice, say, give me the Cadillac, give me the Cadillac, give me the Cadillac. So when they come in, I said, I need an audit, I need an audit, I need an audit. Well, you may have to analyze and say, is it really a requirement that you have to have an audit? Would a review engagement be sufficient? Like as far as that goes there. You can't come in and tell the client, well, I don't want to do audits because there's too much extra work or whatever the case,
Right.
so I'm only going to give you a review, and then find out that the fact is that the banking requirement or the bonding requirement required audited statements. So you got to make sure that you know who are going to be the potential known users of the financial statement, and why were those statements produced, for what purposes. And that's part of your business risk and your audit risk, or whatever, from an analytical standpoint.
Yeah, it's like saying, well, I'm not going to do an audit. There's too many checklists. I don't want to go through the checklist. You have to be open-minded when that client walks in, and that word determine is a big word. You've got to be able to work with the client and through their documentation and determine what it is that that person needs. And the better adapt you are at doing those things, the more clients you're going to have, and the more happier clients you're going to have, as opposed to you having somebody come in and saying, I can only do compilations. So if you need anything else, this is the wrong place. Well, then you're never going to pick up any reviews or audits to be able to get that other experience. So you've got to be able to, your clients will grow with you. They can start off in a compilation environment, but as they grow, they might need a review down the road. Today, audits, unless they're statutory audits, there are probably fewer audits on a small scale for small business. There may be audit requirement for banking, there may be audit requirement for bonding, but in most cases, the bank will probably charge a higher rate if you give them a review, and give you a break on the rate if you give them an audit. So there's mitigating circumstances in which you can switch from an audit to a review, or a review to an audit. And we've been faced with that in the past, where the banker has just come out. If I get an audit, the rate is 2 points above, and if I get a review, it's 2.5 points above prime. Okay? So that's probably what you need to do. And again, these things over here, you're going to have to be able to document them in your file. I keep reiterating that the whole process is going to be in a file format, whether it's paperless or whether it's with paper.
Okay, so we're in the subject matter called takeover steps. So you should obtain like an appointment letter and authorization to obtain information. authorization to obtain information, A, from government agency, but B, from the previous accountant. So you're going to issue the takeover letter, including the copy of appointment and authorization, because anybody can send a letter to anybody, but who's to say that you actually talked to any? So the point is you're going to go to other CGA or other CA and say, look, I want to take over the letter of ABC. Here's my authorization to obtain that information. Please respond to me and give me an information that is appropriate, like if there's any known reason why you're not accepted. If the accountant doesn't respond back to you, depending on the nature of the file and the depth of the file, you should send out a second request. If the second request is sent out and it's not responded to, you could do a phone call and say, hey, Bob, send you out a couple of letters. Have you been away or haven't had a chance to respond to it? I would really appreciate if you send that back there. Failing that point there, then like I think John had a few comments.
The comments I'd like to make over a takeover letter, it's one, it's your responsibility under the Code of Ethics is to communicate with the previous accountant and to let them know that the client has decided that he's requesting you to become the accountant of the organization. And so that's a formal requirement that you have to do. Secondly, the client may only have parts of their records or parts of their financial statements or parts of their tax return, and that information may have to come from the previous accountant. There may not be the details that go from the actual records to the financial statements, and you need to have that continuity to go from year to year. So communicating with the previous accountant may be a formality, but in some cases it may be more than a formality. You actually have to get information from that person. And that's why you would get an authorization from the client, and you submit that to the other accountant and say, I'm authorized to request a detailed copy of the journal entries you had last year, or the receivables, the payables, things that the client might not have. Some accountants might not have provided a full GL. They might have done using the client's records and using their worksheet to be their final GL. So you won't have that link between the actual client's records and the financial statements. How do you go from one to the other without actually redoing that year? So it's very, very important for you to be able to do that. And whether or not you send a second request or you send a third request will depend on the information you have. If your client has all of the information, financial statements, tax returns, GL, there's really no mystery. There's really nothing else that you need. List of inventory, payables, all of that stuff. Then you might send a second request, and if you don't get a reply, then fine, you move on. Question?
I guess these formal procedures applies only to incorporated business?
No, it applies to you.
For how about those small sole or
Oh, you're talking about the
partnership?
type of client.
Yeah, yes.
The type of client might be a convenience store, as an example. It's not incorporated, right? Well, it's still a business. You're still communicating with the previous accountant. As long as you have financial statements and a previous accountant exists, it's your responsibility to communicate.
Well, for tiny businesses, they don't produce a financial statement. It's just for information for T1.
So there's no other accountant. If there's no other accountant, you don't communicate with anybody else. If it's so tiny that there's no other accountant. I mean, if there is another accountant and you've taken over a client, I just don't know, we can't evaluate it based on whether it's incorporated or unincorporated, because lawyers are unincorporated, or they can be through, but you would still send a takeover letter, an engineer, a doctor. So you have a lot of businesses that are unincorporated that are businesses, and they would have an accountant. So I really don't know I wouldn't send a takeover letter if I had a commissioned salesman, and it's a T1 that I took over. No. Okay, but I'm not doing a financial statement. I'm not asked to do a financial statement All I've been engaged to do is to provide, to produce a tax return, right? Personal tax return. Yes?
This is not something I'd work on, but going back to the small business world, with the very, very small businesses, how many businesses we all know just deal with cash, right? If somebody comes to you to do their corporate tax return, how many, you've still got some obligation to look at the numbers and feel comfortable with them, but how can you, right?
Well, okay, again, you know what, when a question is so open-ended, it's really hard to give you a specific question. When we take over a client, they have records. They have formal records. Metro deposits a lot of cash, right? Longo's deposits a lot of cash. There's a lot of businesses that deal with a lot of cash. So I'm not going to be afraid just because they deal with cash. So that I'm already assuming that there's a problem because the business revolves around cash, right? So it depends on the record. It depends on how the records are maintained. It depends on all of the other things that we talked about before, the HST, the payroll taxes, all of those things, right? So yes, there is an element of that there could be unreported revenue, but it depends on what the system is generating in terms of what the sales are, right? Right? In some cases, in the olden days, when everything was manual, what you end up having is a cash clearing account that would have a significant credit balance. And what you would do with that in a corporation is recognize it as a revenue and charge the shareholder. So we would definitely not do anything that wasn't legal, but we would still provide the facility to be able to make that person report and meet their obligation to be able to report, right? And some businesses actually use the cash to pay expenses, right? Hairstylists, hairdressers. We can go on and on, right?
Like you said, don't forget, and when we first talked about it, you have to have your evaluation of what you believe the person's integrity is. If the guy comes in and starts bragging that I'm not doing it, he said, look, but I really don't need this hassle, no matter how mature you are in your practice. Like I try to reiterate, as you have a lower or smaller practice there, you tend to be really happy that anybody walks in your door, but you got to be really, really leery that the fact is that people are coming into your door figure that they're going to take advantage of you. And the reason they're going to take advantage of you is that they want you to just blindly report something, don't even ask a question or infer that there's, I really think there's about $30,000 or $40,000 of sales missing here because your cost of sales just don't make any sense. Your inventory doesn't make any sense. I mean, even if you do a compilation there, and we'll talk about it a little bit later, you just can't associate yourself with that there's a strong inference or there is an actual inference that those are false or misleading information for whatever reason. Yeah, question over there?
Actually, before your question, I just want to add a couple of things. I think that was a really good question. But to go back to what we were talking about before, you really have to determine what you're dealing with, and you have to analyze what the client is. And you're the CGA. You're the one that's going to be going through that process and determining whether you're going to go to first base, second base, third base, or hit a home run. You're going to elevate it. And if you feel that it's not warranted for you to move on, then you're not going to move on. So the moral of that is that you should be doing that. There should be skepticism in what you're getting in order for you to be able to protect yourself and do a proper job. Yes?
I'm not sure if you cover this later on or not, but what are we entitled to get out of the client's file from the other accountant? That's one part of the question. The second part is how has been your experience in the past getting information from the other guys, the CAs, I guess, and the non-designated guys? I'm not sure if you ran into them, but I know they're out there, and whether you get the cooperation, and if you don't, how you deal with it.
My experience, I think, has been pretty good. It's actually been better with CAs than non-designates. So I really haven't had a lot of problems. I've had a few, but but not a lot of problems. Bruce, you would say the same thing.
Same idea. I mean, the worst one that we had with the fact is, yeah, you can come in and do whatever, but you had to pay, what, $5 or a copy?
Yeah, he actually charged us for the copies.
So we said, fine, you know, like.
We did that. That was from KPMG at one of the offices.
So like at that stage there. But I mean, the whole idea.
But that was fine. We still got our copies, and you know.
Remember, the whole idea, if they have the actual source documents that are the client's records, you can't hold back on them for whatever reason. You know, if there's a dispute over fees or whatever, you have to release them. So if you have the GL there and you've got the year-end adjusted entries to adjust the GL, like John said, then you have to provide that information back to the client. Because you got to remember, it's the client's records. It's not your records. The only thing that's yours, technically, is that report, and plus the support and documentation of your working papers. But your working papers are exposed to scrutiny by external people.
I have one experience with a non-designate where I couldn't really make heads or tails of what was in the corporation, and we had to go back and recreate a lot of things, and there was absolutely no communication. And really, I really didn't have a lot of resources to provide. At least if they're a CGA, a CA, or CMA, you can report them to their association, and there's a discipline process that can start or with the complaint. But the other way, I really don't know what else you could do. Yes, another question.
Yeah, I have a client where I was doing the bookkeeping work for him, and a CA was doing the NTR and the tax return. So I'll be taking over that file going forward, but the client still wants the CA to review the file for a couple of years because he's starting a couple of corporations. So in that case, still am I required to get the takeover letter from the CA? Because he's going to review the whole file again.
Do you have a relationship with that CA?
Yeah, I am, yes.
Yeah, then you should do it. You should do it on a formal basis. You could even hand it to him. Say, you know, I'm formally just giving you the letter, and I'm going to continue. I'm going to start doing the compilation starting this year.
But he will be reviewing the file as the request from the client.
He will. Who will sign the statement?
I will sign. He will review the file and just give it back to me.
Once you finish your engagement, your client can do whatever he wants.
Okay.
So that's fine. So even though he's going to be reviewing it, his engagement with the client is a separate engagement. You know,
Okay.
he will charge the client for reviewing
The files.
your work, but he's not signing anything. So yeah, I still think you should do that. You're the new accountant, and you formally should produce a takeover letter. Yeah.
Can I modify the letter to reflect the real situation, or is the standard template I would be using?
You just asked him, is there any reason why you can't take over the file?
Yeah, and if you want to put other things on the letter,
That's your
fine.
choice.
But I just think you have to be careful what you say on the letter, because it's a unique situation for somebody to just take a look. I mean, to take a look at it. He may have a group of companies, and your information may filter into those group of companies. That doesn't necessarily mean that he's actually reviewing what you've done. So I'm a little confused at exactly what the relationship is, right? Because you're saying you're going to sign the statements. Those are you're the accountant of record, and that's how you should treat it. Okay?
Thank you.
Anybody else? Okay, so like you said, the takeover letter, if it gets to the point that they never respond or you can't get a response out of them, then you got to get a little bit of
Skepticism.
In the fact is, maybe you want to look at that file a little bit closer to find out if there is a particular reason why that other person is not responding. As John said, if they are designated, you do have recourses against their association or institute or whatever the case may be. Once you got to all those points there and you're really satisfied, you've done a little bit of review and you're pretty well happy there, then you write the engagement letter. And like I said earlier, the engagement letter said, well, what are you engaged to do? Are you engaged to do a compilation? Are you engaged to do a review? Or are you engaged to do an audit? Because that's going to be the basis for and your contract signed between you and the client to perform that service and that service only. If something else comes up throughout whatever process you're in that necessitates a different stream of review or a different stream of income, you have to have a separate engagement for that extra stream. So if all of a sudden you had to go over on left field, you may have to have a separate engagement to do that. Okay?
Okay. Engagement letter.
Hang on, one question.
Oh, okay.
Excuse me, is there any standard format for
Absolutely.
takeover letter? Yeah.
Absolutely. They're in your public practice manual.
Okay, thank you.
Yeah. And depending on the softwares that you decide to use, there's packages that you can purchase which include what the current formats of those letters would be. They'll maintain it and keep it current, whether it's the checklist that deals with the compilation, the checklist that deals with the reviews or the audits, and also the letters, the engagement letter, rep letter, audit waiver, differential reporting, all of those things.
Okay, so the engagement letter is an actual letter between you and the client. So it sets up the objective and the scope of the engagement, the extent of each party's responsibility, what type of communication, like I said, in a compilation, a review, or an audit, the duration of the engagement, the method of billing, the terms of payment, and any additional services that are going to be provided. If you want to look at a sample of an engagement letter, then we can look over in section 3. And if you get down to 3.2, which is right after the pages of 2.6, okay? So it's an address from you, the external accountant, to that particular client. And it says, I'm here to confirm. Okay? Sorry, the page out numbered. The one page before that is 2.6. So it's very well the next page over. You got call and see accurate on the top. So the engagement letter are within your public practice manual. Like as far as that goes, it gives you different samples of different type of engagement letters. So this one has to do with a compilation per se. But it gives you an idea of the scope and the texture that you have to actually reiterate. And as you can see at the end over under page 3 there, you get the actual client to sign off on it. You should not do any additional work on that particular client until you actually have a signed engagement letter. There's different ways you can do the engagement letter in the sense of how you present it to the client. You can have your preliminary meeting, as far as that goes, do your due diligence, your self-review, get the takeover letter, and either A, have another follow-up meeting with the client and get them to sign the engagement letter, or mail it off to them. But especially, don't forget, if it's a new client, it's always better to do more of it in a person standpoint. Shows a little higher degree of care and concern or whatever of that format. If it's an existing client that you are renewing per se, then the engagement letter can be signed when you take over, when you actually sign off the year-end statement. Usually it's recommended that the engagement letter is always stated before the financial year end. And most of the programs, at least ours, will give you the example that they'll pick 2 weeks before. So if you have a December 31st year end, the letter will be dated December the 17th. Because remember, I want to take you out to the dance. So I got to ask you to say, please, let's go out for the dance. I'm asking for a date. So if I just showed up at your door and said, let's go for the dance, the odds are you're going to slam the door on my face and go away. So you have to be engaged. You got to specify what you're supposed to be doing and then perform whatever that particular engagement is. Okay?
Yeah, not much to add. It's pretty...
No, but like you can read, like I said, the whole idea, at least you look at an engagement letter, it'll tell you the content and the involvement. So that's part of your objective and scope. Okay?
Okay.
Training client staff. That's if they have staff. Teach the client staff to prepare schedules and working papers. So hopefully, just think it's very simple. If you got a client staff there and they got an in-house bookkeeper or whatever, or the wife or whatever the case would be, or the husband, are you reconciling the banks? Are you preparing an accounts receivable subledger? Are you aging those accounts receivable? Have you prepared an accounts payable subledger? Have you prepared the quarterly, monthly, annual HST report? Have you prepared the monthly remittances? Have you prepared the quarterly remittances? Have you made corporate installments if it happens to be a corporation? If it's an individual, did you make your personal installments if those are required? So when you teach your client to prepare schedules or working papers, those are things that they would technically need to do anyhow. And the more that they do, in theory, the less you do, or you're doing purely as a review. Remember, you're charging for services rendered. If the client cannot do it or will not do it, doesn't care about doing it, then in theory, your fees will go up accordingly. So if they have all they brought you in was the plastic bag full of data and whatever the case would be, then obviously there should be a fee to summarize that data, which should be the bookkeeping charge, and then maybe charges for other little components of it, and then there should be a charge for the year-end financial statement corporate returns. Tell them what they need. Like I said, accounts receivable, accounts payable. When you start off first, you should get copies of minutes and audit waivers. And when we talk about an audit waiver, every corporation is required to have an audit unless they are specifically waived to do it. So unless they have more than, 50 shareholders? Like as far as that goes there, then they're not statutory required to have audit statement. As a legal technicality, they should sign a consent to say that, oh, by the way, I want those statements to be prepared under whichever categories, compilation, reviews, or audit, but I do not want them to.
Well, it can't be under audit.
Sorry, not under audit.
The audit waiver has to be unanimously
Signed.
consent. It has to receive unanimous consent by all the shareholders.
Okay. And also, you got to clarify, because clients listen to the words. I always remind them that it's the audit waiver from preparing an audited statement. It's not a waiver from being audited by Revenue Canada. I signed that waiver, so why are they coming in? So people are a little funny that you got to just watch out how you say things. Okay, year-end information, your plan and memorandum. No, much of this information could be in the permanent file. Well, hopefully it is when you first start off. You got the client's name and address, the client contact names, their phone number, their fax number, and their email. It would be nice that you know where they are, and how to get a hold of them. What is the year-end date? Because remember, if you got one client, not hard to lose. But if you got 100 clients, you better make sure that you got them all layered by when their deadlines are, when their fiscal year ends are. The name of the CGA in charge, obviously if you have staff involved. Type of engagement letter required. There's the 3 categories. The bank name and address, the lawyer's name and address, the insurance company name and address, and other pertinent information. Dates when the information requested and received.
I guess I find this slide a bit confusing, because we're talking about year-end information, and we're talking about planning memorandum, and this is not a planning memorandum. This is more of a client profile. A lot of this information is information that you would have on the client profile that you would carry forward and only make modifications as those things change. So it can be in your permanent file. In our case, our client profile is within each individual file. It gets printed out. The one that comes from a review or an audit is a much more detailed client profile, as opposed to the one that comes out for compilations. It may have just that particular information. The planning memorandum deals more with you deciding what it is that you're going to do, who will do it, when will it be done, and integrate other information that's required by you to be able to follow that up. And a planning memorandum is an excellent thing to have in your compilation, although it's not mandatory or required. When you escalate it in a review and an audit, a planning memorandum is definitely essential. It's an essential part of the file. And when you get to an audit, as an example, you'll have to do something that we call a walkthrough the organization and document the interrelationships within the data of that organization and the business that they're doing, and determine how you're going to attack that audit, right? So,
Okay, so again, if you look at the handout there on 3.4, they'll give you an example of like a client profile. So if you look at it, it's on the opposite page. It says the name of the client, the address, the organization, who are the people, main people involved, like as far as that goes, the banker, solicitor, information. So like I said, those should always be entered. If you're doing a work in paper generator, when you first set it up there, that would be your pertinent data that you would do, and obviously as you carry it forward each year, okay? So it's right after the engagement letter that we just saw before, or right before 3.4, which is on the right-hand side. So it's always nice to see something in front of you with something that we're talking about there, so at least something that you can relate to it. Okay?
One of the things that Bruce and I brought today is that there used to be a course that we put together, and it was called File Review. And this actually has a fully completed compilation file. So for those who want to come up today and take a look at it, it'll be available for you. You can pass it around. And that kind of at least packages one of the engagements that you could be involved in. You can actually see it. Because I feel that as we're going through this information, it's bouncing back and forth between compilations, reviews, and audits, and the information that you need. For those who don't work in a public accounting environment, it might be getting a little bit confusing. And so if you want to take a look at that, we brought it down and made it available.
Your hardest line to differentiate, which most people get confused with, the fact is, when does a compilation start, when does a review start or end, and when does an audit? The compilation, if you go by the pure definition, and that's where you get into trouble, is the compilation said, look, all I've done is take a look at it, kind of sniffed it and kind of smelled it and kind of touched it, and said that anything that was presented was reasonable. Reasonable is a definition that the fact is, okay, I can see that, or I don't see anything that come to me that's unbeknownst to me. As you elevate it into a review, you start getting into inquiry, analyze, like computation, comparative, or whatever the case may be. The danger line between the compilation and the review is the fact is that the overlying principle that you cannot associate yourself with false or misleading information. If something is twinkling in the back of your head when you're doing a compilation, you may have to do specific audit steps or specific review steps to satisfy yourself that there's none untoward. Good example would be like we said before, you had an accounts receivable listing of $300,000, you got an agent listing, you found that $250,000 were over 90 days. Well, under a compilation or review, you're not obligated to confirm them. You're not obligated to do anything query, but the fact that there's $250,000 over 90 days seems a little bit odd to you unless you analyze or took a commentary, what type of business are you in that would require that people are paying you so late, and is that a risk or is that a concern? Should I have to do something else to set up a bad debt allowance or whatever? So how can you just simply say, okay, GL says $300,000, subledger said $300,000, it's age, that's what I'm going to put on my balance sheet, fine, that's reasonable. Well, it's not reasonable if the majority of it, or the vast majority, are in potential exposure about not being collected. So you may have to do an elevated step. You are obligated to do that, and they even encourage you to do it. The danger is that you cannot do a whole pile of review procedures, or you cannot do a whole pile of audit procedures in a lower level engagement and say that you have not performed a review or an audit. So you can't ignore it. It's just that you got to make sure that there's a temperance that you actually look at the stuff there. So you just can't just simply look at a trial balance and just say, that's it. It looks right, it's reasonable, so you have to do some extra additional work.
Actually, probably if we give you an example of just taking receivables, taking it through the 3 engagement, if you were looking at receivables in a compilation environment, you would probably look at the numbers, the receivable number in relation to sales, in relation to the total assets, and at that time determine how much work are you going to be able to, or should you do within that number. At minimum, it may require for you to have a list. As he said, if it's 250,000 or 300,000, have a list of who owes this organization or this business that 300,000. What is it made up of, at minimum? To have it aged may be more beneficial for you to do your analysis, but it's really not necessary for a compilation that you absolutely require an aging. When we move into a review, not only is there a specific checklist that you'll have to go through, that the aging is a must. The specific analysis of bad debts, who you communicated with, what are the bad debts, what needs to be written off. So you can see it gets elevated. When we move up to an audit, the checklist gets even bigger. And now you're into positive confirmation, negative confirmation, the percentages that you receive back. And through all this, keep in mind that as an accountant, you should be looking at cutoffs. You should, and as the engagement gets further along, the cutoff is much more extensive as to what you would do in terms of the cutoff, right? Okay, so this is basically because you're associating with these financial statements, and that's how it moves along. Any questions about that? Trying to make it kind of clear and clean in terms of taking one as you would elevate it through, right? Okay.
So year-end letters, requests for information such as engagement letter, bank confirmation, insurance confirmation, corporate data request forms, accounts receivable list, accounts payable list, and actual list requests depends on the engagement circumstances. So those are the things that you would do, and I think John tried to explain there. As you go up the ladder as far as the report that you're issuing, you are obligated and you are responsible to go to a higher degree of substantiated or verifying that particular information. Okay, next one.
Good.
Master control sheet. This is you from the practice standpoint. You coordinate all your year-end engagement. You provide important information at a glance, a name, telephone number, CGA in charge, year-end date, engagement type. So in other words, how are you going to control the flow of information that's going to come through your office to ensure that nothing's omitted and nothing has been missed or nothing's been formatted? So in theory, you should have a list of all your clients. You know, right now there, if you do, you get yourself on your laptop, or you take your BlackBerry or whatever you want to do. Like at that stage there, you may want to enter in all your contacts there. If it provides extra spaces, it'd be very nice that the fact is that you can add on an extra column, say year end. And if it's really nice there, if you got a little extra space there, you'd say what type of engagement. Notice to readers, NTR, you know, like review engagement, RE, audit, AU, and that would help you just organize. Obviously, worrying about CGA in charge or staff in charge or whatever, you're in a bigger office that you do have other associates or other partners, and you do obviously have staff. Obviously, if you're a sole practitioner, you're the one in charge. Okay?
We're good?
Minimum fee discussed, if any. Well, hopefully you've already discussed it. Usually it's probably highlighted in the review engagement letter. Administrative charges applicable. Actual fees expected. Year-end letter was sent. 3 months follow-up date. 6 months follow-up date. Date year-end information is received. Date work is assigned, and target completion date. Obviously, each one of those points become more imperative depending on the size and nature of A, your firm, and the size and nature of A, that particular client. Assigning work, type of engagement, review, and compilation, budget for work to be performed, who will perform the work in the prior year, level of knowledge of the staff, charge-out rates of the staff, current workload of the staff, and the number of staff required. So as you get larger in your firms there, even if you're on a sole practitioner, as we talked yesterday, you should actually come up with what you believe is a billable rate for different type of services. And in simple math, if you did 3 hours of bookkeeping and your bookkeeping rate is $50, then for client A, you charge them $150. If you did 3 hours of a rate of 75, then you would charge it at $225. If you got 3 hours at 150, you charge it $450. As you get more sophisticated either by the different levels of work you do within your particular practice, and specifically if you got different levels of staff, every level of staff should have their what they call their billable rate. So if you're paying somebody $20 an hour, you may be billing them out hopefully at $60 an hour at that stage there.
Yeah, exactly.
So reason to utilize a checklist. Checklists are great and they're bad at the same time.
Well, checklists are mandated.
No, I know, but I'm trying to talk about the philosophy. The problem with the checklist is the fact, just don't tick them off and not actually read the actual question. The question is actually asking you to do something or think about something. So it is a guidance and it is a lead. Yes, it is mandatory.
You can create your own checklist if that's what you want to do, but you've got to ensure that all of the pertinent information is included. I agree with what Bruce was trying to get at. You want to be careful, and as a practice inspector, I have seen this many times, is that somebody believes that just because they've gone through a checklist, they're not even reading the checklist, that they've actually done that proprietary or the perfunctionary function, but which they haven't, right? So you've got to be careful with that. You just tick it and yes, no, or whatever, but they don't really understand what they've done, and nothing is in the file or the statements are not reflective of what they've indicated. So the checklists are there to, I guess, possibly even remind you to actually do that function, as opposed to you just indicating that that function is done. So be careful with the checklist.
So again, if we go with the part 3 of the appendix, if you want to get an example of what a checklist looks like, 2.0. The first one is on page 2.0, which is the compilation engagement checklist. So it says, determine whether you're going to accept or retain this client, considering such issue. Have you contacted the predecessor accountant and addressed the issues raised from the response? So in other words, it reminds you, have you done a takeover letter? Is the client of good character? We're going back to the integrity of the client. Could the information be false or could the readers be misled? Well, obviously, you've got to be answering the question no, because if you believe something's going to be false or misleading, you should be vacating yourself. Is anticipated use of completed information appropriate? In other words, have you actually really analyzed that the compilation is appropriate, especially when you saw a bank agreement that said that you need a review, or you got indication it should be of a higher level? If the person needs it bonded, all bonding companies need at a minimum standard usually reviews. So like at that point there. And it goes so on and so on. So the whole idea of the checklist is to guide you along, but also the fact is, have you performed or addressed or have you actually done that particular procedure? In a compilation there, the checklists are smaller because they look more at the global issue of the whole file as opposed to specific issues of a category of the file, as opposed to worrying about just about bank, worry about receivables, worry about payables. Here it kind of asks it more at the global scenario where you get into reviews and audits, you're getting specific programs that are specifically geared towards that section of the file.
Yeah.
Okay?
Important thing to note, at the bottom of the file, there's a section that says prepared and reviewed. Most sole practitioners will only indicate that they've prepared it, but you should indicate both, and preferably if it's a different date, it makes more sense that you've actually gone through and reviewed it. You should be reviewing your work. So that would be a good indication.
Remember, as I said, just for your own, to worry about your own, making your own internal thing, it's usually preferable, if you give yourself enough time, let a day go by. So in other words, you did something on Monday, so we signed it off at August the 29th, like as far as that goes there. We put the file to the side. We picked it up again to review the whole file, and we signed it off as August 31st. So first it indicated that you actually did prepare it, and it also indicated that you reviewed. And hopefully by having different dates, and those are truly different dates, not that you were creative and picked up the date, because you don't forget, if you're going to be creative and pick up the date, make sure it's consistent throughout the whole file. How come this one signed on the 30th, that one signed on the 1st? I thought you did everything by the 31st, like at that stage there. So remember, you're human, you make human errors. So be true to yourself. Leave the file on a day, at the minimum, give it a 24-hour breathing if you can actually do it, and then review the file with a clean eye on an overall review. In other words, take a step back from the trees and look at the forest. Have you covered the big global issue? Does it overall look well? Does it make sense? If all those answers are not yes, you may have to re-enter into the details of the file to satisfy yourself, oh, gee, I forgot about this, I forgot about that. Okay?
Okay. Problems from prior year. Unadjusted misstatements, reviews only, items requested and reviewed later or not at all, areas where excessive time was spent, areas that can be performed more efficiently this year. So basically, you have to make sure that not only do you review your work when you're completing this year, when you open the file to do it next year, that you refresh yourself and see where you left off, what needs to carry forward, what needs to be adjusted, and what things you've left that you were going to relook at. It's pretty embarrassing to talk to a client and say, this is what we're going to do next year, and then find that you finished a year and you haven't really implemented the things that you said you would discuss, but it was just in your file. So it's important for you to indicate that. And there's a checklist for that as well, to indicate that you've done it.
Don't forget, remember the basic rule. The first time the client walks in, there should be a lot of surprises. Not knowing about their temperament, how detailed their records are, or whatever. But whatever that gap that requires you to spend extra time or extra time delay that allows you to finish the file in the first year or the year before, then you assume the client's going to be pretty well the same, even though you told them to increase or better it. But you may be proactive as opposed to reactive. So never, oh, did you actually do all the bank reconciliation? Do you have a copy of this? Have you included this? Have you included that? And before you bring the file to me, make sure that all those items are, because last year we missed three or four bank statements and we had to ask you 2 or 3 times. So you don't have to say it in a negative standpoint, you try to say it in a positive standpoint. So the whole idea is remember, if last year, the first year you did the file, you may take 50 hours to do it. Part of that, it was part of your learning curve, part of that was your self-training, whatever the case may be. Then hopefully in this year, to be justifying the fee and to justify that you're actually truly making money, you want to do that file within 20 or 25 hours. And if you have staff doing it, if that staff took the 50 hours because they didn't know anything, supposedly they got another year of training, hopefully they're more efficient too. Because the less time you spend on it, in theory, the more money you can potentially make.
Basically, what we're going through is the mindset of a file. We started off by looking at the prior year and looking at what needs to carry forward. Here, it's actually emphasizing, from a planning standpoint, you've got acquisitions and disposals of assets or business. Is there a new accounting system? Have they developed operational problems? Usually clients have a tendency to just zero right in and tell you things. And if you're paying attention, it usually comes back and you'll reformulate that. Okay, you were telling me about that. Okay, well, can you tell me a little bit more, because I need to know for this purpose. So you should definitely be aware of how you take in this information. Have they recently acquired financing? Does that change the engagement now? Because now they have financing, what are your responsibility with your bank now that you have financing? Does that change the engagement requirement? Is a compilation no longer acceptable? Do we have to look and provide a review because of the financing? Is there a change in accounting policies? Have they gone through 5 bookkeepers in a year? 3 bookkeepers, did the controller just quit last month? All of these things is important for you to be able to do your job. The thing is, the way we're giving it to you is we're talking about a lot of things. But unless we focus it back to what your function is, to actually you being a CGA and you putting a file together, whatever that file may be, it's really not going to be of any benefit, because you're going to leave here and you're not going to be able to know how to implement it. So it's very important that you bring it back and you put it together as to what your job is going to be, right?
Yep. And remember, nothing's absolutely stagnant. Yes, the majority of the business are the same last year, same this year, whatever. So the core of it. But they may have different types of income streams. They may have, because of the economy, they had to spend more time or more area in one area that was a little bit more lucrative in another one. Or to maintain staff there, that they took on jobs that were just barely covering costs there, but it kept the people employed. So then when you start primarily looking at the GP there, you knew that they already said that. So it should not be any big surprise that you don't have to delve into it in any excessive details, because it makes sense that before they were able to do a markup of 20%, so their GP was always around 15 to 18%, and this year they're hardly just covering costs there, so maybe their GP is only like 0 to 5%. So the person's already told you that, so it shouldn't be a big surprise, but then you would still want to reconfirm that issue, that's the main reason why your GP is down. So that's analytical, is query or whatever, but that's also to make sure that you haven't missed anything of a material nature to make those statements false or misleading. So we always go back to the same philosophy about associating yourself with false or misleading. Not from a fraudulent standpoint, just by omissions of stuff and things that make sense. John had an example where he was doing a year-end and he was looking at the file and he said, gee, I don't know why these people are losing. And then he found out that at the very end there that they did a progress billing right on the first day of the next month, which happened to be the first day of the next year, and it was for $300,000. Even though he wasn't obligated to look at that stuff, he just knew it just wasn't making sense there. When he checked out there, the progress billing was that, so he had to set up an accrual to make sense. And then all the numbers that were all looking really bad just started to go back into line. It was like $300,000 or $400,000 invoice.
Yeah.
So it was material, it was very important, but the statements made no sense just the way they were, because they cut it off as of October 31st, and how could you possibly ignore a transaction that happened on November the 1st?
Even something as simple as a deposit in transit, you'd be surprised when you're dealing with sizable amounts, where you have a client that their bank account is positive throughout the year, and all of a sudden, you look at the end of the year, your financial statements, you're in an overdraft position. One, you should know if they have a line of credit or whatever. And the other thing is, you look at it and you go, this is not consistent. Well, you actually look at the deposit book and there's a deposit in transit that's significant. So you've got to be able to make sure that that's recorded to make sense. You're not dealing, you've got to look at your clients, you're not dealing with the CGA at the other end. You're dealing with people at all levels. You might find people that are just able to do their records, they'll do their sales, they'll do their deposits, but they can't do their reconciliation. So you're going to step in and do the reconciliation. You're going to find others that they can do their reconciliation, but they're very scattered in terms of cutoffs and things like that. So you're going to have to spend a little bit more time to make some sense of what's real at the end of the year. And it's applicable to compilations just as it's applicable to reviews and audits. And I think with the problems that have happened with compilations over the past 20 or 25 years, this is one of the reasons why we've had the changes that have taken place in the last 5 to 10 years, that there's much more focus on compilations. And as we said yesterday, it's very difficult for you to not associate yourself with false or misleading information unless you do some work. So unless you do some work to be able to see what's there, it's virtually impossible. I haven't I haven't figured out how to do that, to be able to look at numbers and say they're good. So unless you're that good, you'll be able to just look at numbers and say, okay, they're good to go. You've got to do some work. So we will look at bank statements. We will look at lists. We will look at a list of payables. We will look at the HST reports that they filed. We want to be able to be for the information to be reasonable, and that's the only way that I know. It's through actually doing the work.
I'll retrench it. Okay, so computerized client information and working paper software. So can you actually import the general ledger? You know, can you import the accounts receivable, accounts payable, the inventory? Can you extract them through a spreadsheet? So in other words, like in our case, we use Caseware, and a lot of our clients use Simply. So when we take their basic records and we import them into our working papers, then that information can go from cradle to grave that we have that information involved. We do it in, what's the other one?
Jazz.
Jazz, you know, Jazz gives you the financial statement, but we do it in QuickBooks or whatever the case may be. That importability doesn't always work as cleanly or smoothly because of how people actually enter their data. So the more that you can import the stuff that'll eventually evolve or generate through your working papers, no matter which engagement that you're particularly doing, this gives you a wealth of information readily at hand. If not, then you have to have separate things. You may have to have a separate GL with a separate subledger that is done, and you may have to take copies of it to attach it to your particular working paper if that's applicable. All you have is a working trial balance with no detail behind it. So all your supporting document is by other information.
The other important part of the better the software that you use, the easier it is for you to get information when you're actually meeting with the client. It's pretty easy when the client looks at, when you look at the shareholder's loan account, clients usually get excited. And they'll say, well, I didn't take that money. And you scroll down and you say, well, there's a check that you took on that date, another check that you took on that date. And all of a sudden, oh, yeah, I remember that. So they don't challenge you. Otherwise, you would have to stop the engagement, have it looked at, come back, and have another meeting. So having that information available to you is very, very useful in terms of making your relationship with your client work. The other thing is that clients want to make sure that you know what you're doing. So they'll actually challenge you on different things just to see, yeah, this guy knows what he's doing. He's fairly accurate. I think I mentioned it yesterday. We were doing an audit of a client for many years, and once we would sit down to do the year-end meeting with the client, he'd come out with his records in terms of what his GP was, in terms of what his bottom line was, and he maintained all of these things manually on his own. And luckily for us, they always worked out. We're always on the same page, or else it would have been pretty, well, we would have had to investigate to see which one of us was wrong. But you'd be surprised. They don't have to be accountants to know numbers. Usually they're entrepreneurs and they really know numbers and they want to succeed. So that's what you're dealing with.
Well, and with that particular client, I finally learned the terminology with them. I said, is that a book sale or is that the sale that's coming down the road? Because these were the project-orientated client.
Yeah.
Project-orientated client. So when he books a sale there, he knows that the fact is, okay, I'm going to do $1 million to do whatever to produce that particular widget, but it's going to take me 4 months to produce the first wave of that obligation. So therefore, my income stream will not start till he has a September year-end. My first income stream won't start till the second quarter, which will be January, February. So if I'm able to produce, let's say for argument's sake, he was supposed to produce 50 items, and these would be large value items, then he would have 15 produced by the beginning of January, and they would have another, like and so on. So then you say, okay, fine. So that $1 million is not part of the September year-end. It's going to be part of our forecast within the next year-end. So we always got into this terminology, okay, when is the sales going to start and when is it going to end there? So then we can adjust our numbers to see if that we're closer into.
Right.
And he said, oh yeah, that's right. Because he said, by heart he was a salesman. I booked the sales, I got the commitment there, I don't care if it's 4 months or 5 months, I know that money will come. So in his mind, he's done his job. But from a cutoff standpoint, and from a work in process standpoint, and from an inventory valuation standpoint, we got to know when the line started, where it is, and when does it end. Because in that particular client, we had a lot of cutoff problems. Questions?
And I guess the other thing that I would add with that is that eventually he educated himself and he would make that adjustment and he would tell us at the meeting, I've got this much revenue that's going to be in next year. And it actually provided comfort for him to know that he already had contributed so much to the bottom line for the next year as well. So it kind of, having that interaction educated him a little bit and it educated us. And the relationship obviously still works and we still have him as a client today. So that's the important part. Yes?
Yes, my question was regarding the sales that you were talking earlier that was booked but has not yet been received because you haven't commenced production yet.
When I mean booked in his mind, he books it in his order books.
Okay.
Like it's not booked as
Not recorded.
It's not recorded as a true accounts receivable.
No, but my question is this. Wouldn't a situation like that be recorded as a deferred revenue?
No.
This, okay, let me explain a little bit because I think Bruce confused you with that. What happens is that they take orders. They take orders. So these are orders that are coming from overseas. And, actually, other than taking an order, nothing else might have been done. So he keeps track of all these orders. So for him, an order will initiate a lot of things. And we analyze that to an extensive level to see what belongs in the year end. But beyond that, we're not recognizing something unless it's invoiced. If there was an invoice that was actually created, in some cases we do have the unearned revenue where our customer is actually putting money down towards an order, and there's a paper trail that's created at that point, right? So it gets a little bit involved. Actually, it's probably a little bit too complex to have brought it up, right? So.
Okay, but there's a perfect example. When you only hear partial information, then the full story is not there, so you cannot come up with a true analysis of the format there. So like I said, this particular individual, like I said, he's a salesman. So as far as, like I said, as long as he got the order, he was happy that the order was done. Remember, you cannot book a revenue until the service is performed or the goods are delivered. So they got to be in a deliverable state. Here he had to import the stuff, he had to massage it, he had to assemble it, or he had to have it actually built. So we had two different timelines. The first timeline was, okay, have you got a commitment against the purchase of whatever that item is to be sold? Where does it stand on the totem pole as far as work in progress is concerned? When does the work in progress end that it becomes inventory? And then when is that inventory delivered to the client, so therefore we have a sale? So we always had these continuities of format there. Yeah. So when John talked about the client's very savvy in the sense that what he knew was going to come into the revenue, he always said, I have $5 million of sales. I said, no, I think you only got about $3.5 million. And we said, oh yeah, that's right, because I got $1.5 million there, but it's not going to commence till the second quarter, which is going to be January. So that, as John says, as time went along, we got both our terminology on track that we said, okay, right, this happened from this period, and now we know exactly what happened. Our issues was where is in the timeline from a deferred revenue, from a customer deposit, from a work in progress, from an inventory. So we had a lot of cutoff issues.
Right.
But it was a review engagement. At one time it was an audit engagement. So we were well versed about doing whatever procedures we had to do.
Yeah, and again, just to finally put it to bed, you've got to do you've got to put in your time and do the work, because there are so many situations that could occur. We couldn't possibly address them all over here, and so whatever file you're working on, you've got to keep your eyes open, and you've got to go through the procedures and look at where the cutoff stands and what should be in, what should be out, and take it from there.
Good word, cutoff.
Yeah.
Okay, hang on, we'll answer one question, and then we'll break for that fun thing called lunch. Right? Good.
So in situation where you have one corporation but two separate lines of business,
Okay.
so how would you handle the checklist, the paperwork? So do you do two separate? And in this case, what risks would you see from this?
Yeah, so in other words, basically, you've got one corporation operating as two different companies. Is there separate records for both? So there's a separate bank account for both? Okay, there's two bank accounts. Is there separate inventory for both? Is there separate... Okay, it really depends. It really depends if they're completely separate. You would still only have, say, one checklist, but it would be backed up by both. The financial statements would probably have to indicate that you're operating two different things, right? Do both companies operate indicating that that corporation? Same corporation.
Just
So
two
the
divisions.
public doesn't see it. Like I'm just trying to get a handle on it, right?
You got two operational divisions.
One sec. Can you repeat that again?
So it does have two business names, like operate under
Two operating names.
two
Right.
two operating names.
So is there two lines of credit? Two lines.
two separate?
Lines from the bank.
Yes.
One financial statement.
Yeah, one
Because you
corporation.
can have, like, we, as an example, we have one where we have one corporation and we have two components. But when we do it, we actually do the two components as two separate files. And then we marry it into the other one. Or we actually do the one company and bring it down to the two. But
So you still
yeah,
do it separately. I
we
suppose.
would. Or you can do it within, let's say you're doing cash, you'll do cash, but behind the cash, you'll have both. You'll do one and then you'll do the other one. And then on the lead sheet, you'll have both coming forward, right? It really starts off with what you're issuing. How many statements are being prepared? If it's only one statement that's being prepared, how you do the work, it would be your choice.
Are you issuing one income statement or two income statements?
We tracked it separately, yeah.
So you're showing division one income
Yeah.
statement, division two income
Yeah.
statement.
That's the only
Well,
way
like
you
I said,
can
though, when
track
you
it.
get into the revenues and expenses there, you can segregate those.
Yeah,
Like
yeah.
as far as that goes there. Your lead sheet can have Division One bank, Division Two bank, but only have those two numbers that'll be show the one overall bank. So it's almost like you're doing a consolidation,
Right.
but you're doing it within the company. The only thing you have to worry about consolidation is the fact is, unless you're setting up a receivable payable between the two divisions. Like if one is supported on the other one may be a receivable and the other side is a payable. Well, obviously when you put the balance sheet together, like what you do with a consolidation, they would just eliminate, like as far as that goes there.
Do you have two separate general ledgers?
It's something like you tracked it by more like divisions, like two business
Excel?
lines.
Oh, yeah, then,
You
then
do
I would
have-
I would only do one set of files and back it up
Okay.
with both bank accounts, with,
Like main lead sheets and then sub lead
yeah,
sheets.
sub-lead sheets.
Okay.
So in other words, it's like just break it up there, but you just may have a different approach for the different revenue streams, because they may be handled differently. Okay, so I don't think there's
Lunchtime.
is there any,
Online?
any more online? Anybody doesn't want to have lunch? Okay, so how about we, again, try to reconvene about 12:35?
I just make a quick note that on the plasma screen outside is the session from yesterday that was archived. So in case you're kind of curious what it looks like to the online participants, it is showing outside the lunchroom. Okay?
Yeah, so don't laugh.
You all look like rock stars, by the way.
Yay. Well, this is